Next, we will move to the Unit 3, Income from Business or Profession. We will have a brief introduction about some key terms. First one, business. Business refers to purchase and sale of commodity with a view to earn profit. It includes any trade, commerce or manufacture or any adventure or any concern in the nature of trade, commerce or manufacture. Any transaction with a motive of selling at profit is included under this concept. It is not compulsory that transaction should be continuous and permanent in nature. The business should be carried in the current previous year. The owner of the business will be taxed for the business carried on by him or by his agent or by his manager, etc. Then we'll see the profession. Profession refers to activities of earning using intellectual skills. For example, doctors, lawyers, engineers, and auditors come under this category. These type of person also having a separate and specialized course to attain professional knowledge. Then, vocation. Vocation implies natural ability of a person for some particular work. The term vocation is expressed differently in different case laws, but all falling under the ordinary and accepted use of the word profession. Tax expert, journalist, architect, cost accountant, and management accountant come under this category. Income that are taxed under business or profession. The following are the income which are taxable under this head as per section 28. First, profit and gain of any business or profession carried on by the assessee during the current previous year. Second one, profit and gains of managing agency. Then, income from speculative transaction. Then, income derived by a trade or profession or similar association from specific services performed for its members. Then, any interest, salary, bonus, commission or remuneration due or received by a partner of a firm. Then, any sum received under Keyman insurance policy including bonus. Then, money received for not to share any patent, copyright, trademarks and know-how, etc. The next one, profit on sale of a license granted under the Import Control Order 1955. Then, cash assistance received or received by any person against export under any scheme of the Government of India. The next one, any sum received or receivable on account of any capital asset in respect of which deduction has been allowed under section 35 AD being demolished, destroyed, discarded or transferred with effect from assessment year 2010-11. Then, any money or profit on transfer of the duty entitlement passbook scheme. Then, any money or profit on the transfer of the duty free replenishment certificate. We can see some rules to be kept in mind to chart an income under profit and gain of business or profession. First one, tax is chargeable to the person who carries on the business. It is immaterial whether the assessee carries on the business through a manager or an agent or a servant. Then second one, tax is charged on the total income from all businesses or profession carried on by the assessee. For example, if Mr. A carries on 3 businesses and earns 10,000, 20,000 and loss of 6,000 as profit and loss, then his total income from business will be calculated as follows. First business income 10,000, second business income 20,000, together 30,000. Then third business tax, it should be deducted with the business income 6,000. Then the net income from business will be 24,000. The assessee can carry on the business at any time during the previous year. Tax will be calculated on the actual profit earned during the current previous year and not on the notational or anticipated profit. Then illegal business income is taxed. The excess income after allowing the actual expenditure to earn illegal business income is taxed. Then business losses which are considered to be incidental to the business and not of capital nature are deductible during the current previous year. Then any amount allowed as deduction in the earlier year, if recovered during the current previous year, then it is taxed during the current previous year. The next one, any amount received by a sportsman in his professional capacity is taxable as professional income. If it is received in any other capacity, then it is treated as gift and not taxed as professional income. To decide whether a person is a professional sportsman or not is left to the discretion of the assessing officer. Then we'll see the various terms under the business. First one, speculation business. Speculation business consists of speculative transaction. A speculative transaction refers to a contract for the purchase of sale of any commodity, including stock and share, is settled otherwise than by the actual delivery or transfer of the commodity or scrip provision certificate. Section 45 subsection 3 of the Income Tax Act 1965 has dealt with speculative transaction. Speculation business is deemed to be distinct and separate from any other business. Speculation transaction equal to any transaction without actual delivery. Note, speculation business income is calculated in the usual way as business income is calculated. Speculation loss can be adjusted, set up only with the speculation profit. Then we go for the illegal business. Any business activities which is not permitted by law is illegal activities, and business carried on with such activities become illegal business. Income earned from such illegal business will be taxed under the Income Tax Act 1961 after allowing all the expenses the assessee has spent in the order to earn such income. The Income Tax Act does not make any difference between legal and illegal business income for tax purpose, but at the same time, expenses spent to earn illegal business income cannot be adjusted with legal income. Then, bad debt recovered disallowed earlier. Bad debt recovered disallowed earlier refers to any bad debt which has been disallowed as a deduction while calculating business income in the earlier years preceding the current previous year, but received during the current previous year. Any such amount shown in the current previous year profit and loss account should be deducted from the current year profit since it has already been taxed in the earlier years. Then, bad debt recovered allowed earlier. Bad debt recovered allowed earlier refers to any bad debt which has been allowed as a deduction while calculating business income in the earlier years preceding the current previous year but received during the current previous year. Any such amount shown in the current previous year profit and loss should be added to the current year profit in order to tax the amount since it is not taxed earlier. We can see the simple format of a business, how the tax is calculated. Just we take first net profit as per profit and loss account, add disallowed expenses, then second one business income not credited in profit and loss account, then undervaluation of closing stock, then overvaluation of opening stock. So this should be added with the net profit. Then the various items should be deducted. First one, non-business income credited in profit and loss account, allowable expenses not debited in profit and loss account, overvaluation of closing stock, undervaluation of opening stock. This should be deducted from the net profit to get the income from business. Then expenses expressly allowed. We see the various expenses allowed. First one, expenses on building, section 13, rent paid, repairs and maintenance, land revenue, local rates, ground rent, municipal tax, insurance and depreciation. Amount allowed as deduction will be full. Note, if assessee owns the premises, no deduction as notation rent, repairs, etc. Then second one, expenses on plant and machinery, furniture, section 31. Repairs and maintenance, depreciation, insurance, hire and lease charges. Full amount will be exempted. Then third one, investment allowances for acquisition and installation of new plant and machinery, section 32 AC. Cost should exceed 25 crores, should be installed on or before 31st March 2017. Available only up to assessment year 2017-18. 15% on cost of new plant and machinery. Next, we will see the investment allowances is notified in backward area in Andhra Pradesh, Bihar, Telangana and West Bengal. Section 32 AD. New plant and machinery should be acquired between 1/4/2015 to 31st March 2020. The business should be sent on or after 1/4/2015. 15% on cost of new plant and machinery. Then expenditure on scientific research, section 35, revenue expenditure for assessing himself. Second one, contribution to approved scientific research association, payment to an approved university, college or institution for scientific research for undertaking scientific research. Then contribution to approved association which undertake research in social science or statistical science included approved university, college. Then capital expenditure on plant and machinery, equipment, building, etc. on land acquisition. For these, first one, revenue expenditure, full amount. Then with regard to contribution of approved scientific research, 175%. Then contribution to approved association, it is 125%. Then capital expenditure on acquisition of plant and machinery and land, fully not allowed. The contribution national laboratory, section 35 subsection 2 AA. National laboratory means a scientific laboratory functioning at national level under the aegis sponsorship of the Indian Council of Agricultural Research or the Indian Council of Medical Research or the Council of Scientific and Industrial Research, the Defense Research and Development Organization, the Department of Electronics, the Department of Biotechnology or the Department of Atomic Energy and Indian Institute of Technology or a university approved, 200% is allowed. From assessment year 2009-10, any contribution to company for scientific research use, 125% is allowed. Capital expenditure incurred by a company engaged in the manufacture or production of drugs, pharmaceutical, electronic equipment, computers, telecommunication equipment, and development facilities as is approved by the prescribed authority, section 35, subsection 2 AB, in-house research and development expenses. Expenditure incurred up to 31st March 2017 is to be considered. 200% is allowed. Then, expenditure on acquisition or purchase of patent or copyright, section 35A, if expenditure is incurred up to 31st March 1998, 1/4 of the total expenditure is allowed. If expenditure incurred after 31st March 1998, from 1st April 1998, 25% is allowed as depreciation. Then, expenditure on know-how, section 35AB, not applicable now. If expenditure is incurred up to 31st March, know-how, 160 is allowed. If know-how developed in any Indian laboratory, university or institution, 1/3 is allowed. If expenditure is incurred after 31st March 1998, know-how, and if know-how developed in or any Indian laboratory, university or institution, 25% is allowed as depreciation. Then expenditure for obtaining right to use spectrum for telecommunication service, section 35BA, from assessment year 2017-18, for any capital expenditure incurred and actually paid by the assessee for acquisition of right. Deduction is allowed equally for the period of right, total amount divided by period or years. Then amortization of telecom license fees, section 35A-BB, capital expenditure spread over number of years. Actual payment made into 1 divided by number of previous year for which fee is paid, amount allowed. Then expenditure on eligible project or scheme, section 35AC, full amount is allowed. Then expenditure on specified business with effect from assessment year 2010-11, section 35AD, specified business, gold chain facilities, warehousing facilities for storage of agricultural produce and cross-country natural gas or crude or petroleum oil, pipeline, network for distribution including storage facilities, 100% fully exempted. A specified business has commenced operation on or after 1/4/2012, 150%. Then payment to association and institution for carrying out rural development program, section 35 CCA, full amount is allowed. Then payment for carrying out program of conservation of natural resource, section 35 CCB, full amount is exempted. Then expenditure on agriculture extension project, section 35 CCC, from assessment year 13-14, 150% is allowed. Expenditure for notified skill development project, section 35 CCD, from assessment year 2013-14, 150% is allowed. Amortization of preliminary expenses, section 35D, expenses incurred before 1/4/1998, 1/10 is allowed. Expenses incurred on or after 1/4/1998, 1/5 is allowed. Expenditure on demerger or amalgamation, section 35DD, 1/5 is allowed. Amortization of expenditure under voluntary retirement scheme, section 35DDA, 1/5 is allowed. Then amortization of expenditure on prospecting etc. for development of certain minerals, section 35E, 1/10 is allowed. Next we'll see the other deduction, section 36. Employee insurance, bonus, commission, employee contribution to RPF, ESI, gratuity fund, superannuation fund, interest on borrowed capital, loss of animal, bad debts, full amount is exempted. Then family planning expenditure, section 36, subsection 1, schedule 9, revenue expenditure and capital expenditure, full 1/5 is allowed. Then expenditure incurred by a corporation or body incorporated with effect from 1/4/2002, section 36, subsection 1, schedule 12, full amount is exempted. Then banking cash transaction, tax paid by the assessee, section 36, subsection 1, schedule 8, from assessment year 2006-7, note applicable only to the business source of income, not to other source of income. Then security transaction tax from assessment year 2009-10, commodity transaction tax from assessment year 2009-10 is fully exempted. Then advertisement expenditure for souvenir, brochure, tract, pamphlet or any of the mentioned published by political party, not allowed. Entertainment expenditure, traveling expenses, guest house expenses, holiday home expenses, full amount is exempted. Then general deduction expenses, section 37, legal expenses for protecting company's asset, custom duty, excise duty, sales tax etc. paid, sale tax appeal expenses, income tax appeal expenses, day-to-day expense to carry on business, reasonable expense on festival like Dasara, Diwali, expenses incurred at the time of Magrut, compensation paid for terminating undisabled employee or director, workman compensation pay, payment for cancellation of disadvantaged contract telephone expenses, gift to employees, expenses against nationalization. Then expenses for alteration of memorandum and articles, fine for delayed performance of contract, inauguration expenses, installation expense of new telephone and payment made under Warn Your Telephone OIT scheme, deposit under Cycle Telephone Deposit Scheme, any payment given to business rivals agreeing not to compete with the assessee, full amount is exempted. Then losses incidental to business, allowed losses, loss by theft and embezzlement by employee, full amount is allowed as deduction. Loss of cash due to robbery while being carried by cashier for disbursement. Loss of cash by death in case of banking company. Loss due to fire, accident, enemy war action. Loss due to white hand. Loss due to non-recovery of advances. Loss due to destruction by an act of God. Loss due to exchange rate fluctuation of foreign currency held on revenue account. Loss arising from sale of securities held in the regular course of business. Loss arising from negligence or dishonesty of employees. Allowed as deduction. Then we see the expenses expressed disallowed, section 40. First one, guest house expenses. Second one, wealth tax, income tax, fringe benefit tax penalty, penal interest advance income tax, gift tax, estate duty, any other tax which is imposed on income and interest thereon for delay or non-payment. Then expenses of personal nature, drawings, salary to proprietors, interest on capital loan, medical expenses, expenses for family members, LIC premium. You see the provision or reserve for bad debts, provision for taxation, etc. Provision for gratuity, superannuation fund, donation, gift, charity, present, fine and penalties, payment made outside India without TDS, cost, losses charged to profit and loss account, depreciation above the prescribed limit, investment, deposit or allowances and development allowances, all expenses of capital nature except scientific research, any expenditure incurred not necessarily for business, all expenses relating to other rates of income, amount invested in NSS, NSC, PPF, etc. Then there is a hint to be taken into consideration. If amount exceeding 20,000 is paid by a crossed check or a crossed bank draft, then the full amount shall be allowed as deduction. If amount exceeding 20,000 is paid in cash, then the entire amount should be disallowed from the assessment year 2008-2009. Section 40A, subsection 3. With effect from 1/10/2009, rupees 35,000 under section 40A, subsection 3 to be considered in case of payment made for paying, hiring or leasing good charges, other being 20,000. For mediclaim insurance, first one if paid in check, allowed. Second one if paid in cash, disallowed. Then treatment of depreciation. If depreciation is given in profit loss account as well as in the adjustment, add depreciation given in the profit loss account to net profit, subtract depreciation given in the adjustment from net profit. If depreciation is given only in profit loss account and not in the adjustment, ignore depreciation given in the profit loss account while working out the problems. If depreciation is given only in the adjustment and not in the profit loss account, subtract depreciation from the net profit. If any asset is put to use for less than 180 days, only 50% of the actual depreciation should be allowed. Treatment of bad debts recovered. If bad debts recovered disallowed earlier is given in the credit side of the profit loss account, subtract from net profit. If bad debts recovered allowed earlier is given in the credit side of profit loss account, ignore while working out the problems. Then fixing up neon signboard is a capital expenditure, hence it should be disallowed if shown in the debit side of profit loss account. It should be added to the net profit. If any amount is paid outside India, it can be allowed provided there is TDS, tax deducted source. If there is no TDS, the actual amount should be disallowed. Penalty, if shown in profit loss account, should be disallowed. If any tax is paid before due date of filing of return, it should be allowed while calculating income from business. Any interest paid to partner capital is allowed up to 12%. If the rate exceeds 12%, the excess amount paid should be disallowed. Then we'll see the format for profession like doctors, lawyers, accountant, tax consultant, etc. This is profit from profession. Under the profit from professional income should be taken into consideration. That is, fees for all professionals, operation fees, visiting fees for doctors, institution fees for accountant, legal fees, practicing fees for lawyers, gift from client for all professionals, gift from patient for doctors, examiner fees for all professionals, all other professional receipts. Then it should be deducted with the professional expenditure. office and administration expenses for all professionals, clinic expenses and dispensary expenses for doctors, cost of goods for professional purpose for all professionals, subscription for journals for all professionals, then depreciation for office equipment for all professionals, for surgical equipment for doctors as per section 32, any member fee for all professions, cost of medicine for doctors, opening stock plus purchase minus closing stock, all other professional payment. You will get the income from profession. Next we will see the depreciation heading. Under the depreciation, we will have a brief introduction about the depreciation. The Income Tax Act 1961 does not define the term depreciation. The normal definition applicable in accounting term is used as such. It simply refers to decrease in the value of an asset. The decrease in the value may be because of wear or tear, obsolescence, outdated, etc. Any asset used in the business during the current previous year by the assessee will qualify for depreciation. Then second one, asset. Asset refers to any property owned by the assessee during the course of business. There are two types of asset, mainly tangible asset and intangible asset. Tangible asset, which can be touchable and which can be seen. Asset like plant and machinery, furniture, electrical and electronic items and buildings are tangible asset. In other words, any asset which are not intangible asset becomes tangible asset. Intangible asset, which cannot be seen or which cannot be touched. Asset like patents, know-how, trademark, franchise and other business or commercial rights are intangible asset. Any asset which cannot be seen and touched come under this category. Then we go for the block of asset. Block of asset refers to those assets which comes under the same category with the same rate of depreciation. For example, tangible asset with same rate of depreciation will be considered as a block. Intangible asset with same rate of depreciation will be considered as block. Asset, building, rate of depreciation 10%, plant and machinery 25%, patent, purchased after 1498, 25%. In the above example, there will be three block of asset as follows. For tangible asset, block 1 10%, block 2 25%. For intangible asset, block 3 25%. Then we will see the actual cost basis. Actual cost basis is one where the depreciation will be calculated on the actual cost for which the capital asset has been purchased. This type of calculation of depreciation is allowed to an industrial undertaking engaged in generation and distribution of power. This is applicable from the assessment year 98-99. Note, for this type of undertaking, the method of calculation of depreciation is left to the discretion of the assessee. That is, the assessee can adopt actual cost basis or return on value basis as he wishes before his filing of return. Then we will see the return down value basis. This is the usual method which is followed by all business unit to chart depreciation. Under this, the WDV of a particular asset beginning of current previous year is taken along with the purchase and sales made during the current previous year. To calculate depreciation, WDV add addition during the year less sales during the year will get the WDV value on which depreciation should be calculated. Next we will see the unabsorbed depreciation, section 32 subsection 2. Unabsorbed depreciation refers to that part of depreciation which cannot be allowed in a particular previous year due to shortage of profit or of no profit. In other words, any part of depreciation which cannot be allowed in a particular previous year because of non-availability of profit or profit available is less than the required amount. Then the amount which is not claimed as reduction will be termed as unabsorbed depreciation. Tax treatment. Unabsorbed depreciation can be carried forward and set off from any income until it is fully written off. Example, total amount of depreciation 5,000, depreciation that can be claimed in the current previous year 2,000, unabsorbed depreciation 3,000 to be carried fully till it is fully written off. There is no limitation as to how long it can be carried forward. It can be adjusted in subsequent year with any aid of income except salary income. Why depreciation is allowed? The following are the main reasons for which depreciation is allowed. To arrive at real business profit, to determine the book value of an asset in a given period of time, to know the real position of asset in order to arrange for its replacement or renewal after a period of time by setting aside a specified amount out of each year profit. When an assessee can claim depreciation. An assessee can claim depreciation when he satisfies the following condition. Asset should be owned by the assessee. Asset should be used for the purpose of business or profession. Asset should be used during the current previous year. Depreciation can be claimed for tangible and intangible asset. Example, tangible asset, building, machinery, furniture, etc. Intangible asset, patent, copyright, trademark, know-how, license, franchise, and any other business or commercial right. If an asset is sold during the current previous year, no depreciation should be allowed. Then we can see the chart showing rate of depreciation. For tangible asset, building, first one, building used mainly for residential purpose, 5% of depreciation is provided. Then building which are not mainly used for residential purpose, say used for office, factory, godown, hotels and boarding houses, 10%. Then third one, temporary building, wooden structure, 100%. Then building acquired on or after 1st September 2000 for installation of plant and machinery for water supply project or water treatment system, 100% is applicable. Then furniture and fittings, any furniture and fittings included electrical fitting or installation, 10% is allowable. Then third one, plant and machinery. Under the plant and machinery, scooters and cars acquired before 1/4/1990 and cars acquired on or after 1/4/1990, cars other than used in a business of running them on hire, 15%. Note, include general plant and machinery not covered in the following other point of plant and machinery. Second one, wash and going ships, speedboat and other vessels operating in inland waters, 20%. Buses, lorries and taxis used in the business of running them on hire, 30%. Airplane, aero engine including commercial vehicles acquired after 30th September 1998 but before 1st April 1999 and put to use before 1st April 1999, 40%. Fifth one, containers made of glass or plastic used as refill. Then, new commercial vehicles acquired during 2001-2002 and put to use before 31st March 2002 for the purpose of business or profession. Plant and machinery used in weaving, processing in textile industries, 1st April 2001 to 31st March 2004. Then new commercial vehicle which is acquired on or after 1/1/2009 but before 1/10/2009 and put into use before 1/10/2009 for the purpose of business or profession, 50% is allowed. Then computers and new commercial vehicles acquired in replacement of condemned vehicle are 15 years of age, which is put to use before 1st April 1999, if acquired during 1st October 1998 and 31st March 1999, or before 1st April 2000, if acquired during 1999-2000, 60% is allowable. Energy saving devices, rollers in flour mill, sugar works and steel industries, gas cylinder, 80% is allowable. Then machinery relating to environment protection and control, air pollution control equipment, water pollution control equipment, etc., 100% allowable. Then for tangible asset, books. Book for professional purpose are used being annual publication, 100%. Books owned by SSC carrying on business in lending libraries, 100%. Then second one, books other than annual publication owned by a professional, 60%. For intangible asset, know-how, patent, copyright, trademark, license, franchises, and any other business or commercial right acquired after 31st March 1998 or from 1/4/1998, 25% is allowable.